Hello, everyone, and welcome to our tactical portfolio update for October 2025. I'm Michael LeBlanc, Senior Portfolio Manager with LLC Private Wealth at CG Wealth Management, bringing you the latest in global markets, key sectors, focus on the Canadian performance. Especially, we're going to be talking about the Canadian budget that just came out. So let's dive into things. Before I get started, though, just a reminder. We have a new Mike on Money features that we started in September called Monthly Market Mistakes, where we highlight areas of risks that most people may overlook. If you've missed last month's private debt funds or principal protected linked notes, the two first videos, check those out. We've seen a lot more problems arising in those sectors, so there's been some updates from there. Also, you might want to subscribe to our monthly email where we update you on all our content, including our small cap specialist team who put out some great material every month as well. So today we'll walk through the key global market developments for October. We're going to zoom in on the Canadian equity economic landscape and unpack what that newly released federal budget means for Canadian investors and the broader environment. And as always, we're going to take a look at our tactical portfolios. So let's take a look at the global market overview. October got off to a mixed but resilient start for the global markets. U.S. equities rallied mid-month, on earn-in beats and hope for more dovish stance from the Federal Reserve. While the bond markets reflected some relief from inflation pressures, growth stocks, outpaced value for the portion of the month, but rotated sector leadership reminded investors that we're still in a higher uncertainty environment. Meanwhile, global inflation data came in a bit softer than feared, supporting speculation that rate cuts could begin earlier than expected. At the same time, trade and geopolitical concerns remain, in the backdrop, constantly, overlooking everything, keeping volatility pretty elevated. Um, for the portfolio managers and advisors, October reinforced that message, stay diversified, keep that risk first mindset. Here at LLC, we always talk about risk first in the portfolios and monitor where those macro winds are shifting because they will move. Even good companies or good investments are going to be affected by the macro winds. So let's take a look at Canada specifically. Turning inwards. Here's where things kind of shaped up for October. On the equity side, the S&P TSX showed moderate gains through the month, particularly helped by sectors tied to resources. We saw the price of oil come up a bit. Commodities, metals continue to perform a bit. Infrastructure names performed quite well in October. That strength is notable given, our broader economic backdrop that we've been seeing. Economically, the story remains cautious. For example, the business sentiment of Canada weakened. A recent survey from the Bank of Canada revealed that the sales outlook for the Canadian firms dropped to its lowest point in over 2 years. And that's from the Wall Street Journal survey. The trade and tariff headwinds from the U.S. And a weak global demand for Canadian exports are still weighing on our real economy. So when we dig down into those numbers, that's still a big concern out there. On the fiscal front, as we've discussed, the recently published federal budget brought both opportunity and risks for Canadians. We're going to dive more into that. For Canadian investors, the key question is, where do you position yourself in this environment of resilient equity markets, but modest growth, and also with that elevated macro risk? Resource exposures, infrastructure plays, select domestic growth equities maybe have the most attractive risk reward profiles right now. But as usual, be vigilant in your sector and stock selection right now, and also in your asset allocation. So let's take a look at the Canadian federal budget. Let's unpack it a bit. A major element for investors to watch for is a big shift or a big pivot for the Canadian government towards investment-led growth with a large capital spending agenda, big deficit spending. focus on infrastructure, clean economy initiatives, and a productivity super deduction to encourage investment or businesses to invest in themselves. On the revenue fiscal side, the budget acknowledged the weaker growth. Private sector forecasts expected Canada's real GDP growth for 2025 to be around 1.1% and 2026 1.2, down from prior expectations. The budget reinforced a buy Canadian policy, meaning stronger domestic procurement, which could benefit Canadian listed companies with a domestic exposure. However, the downside, increased fiscal risk. We're going to be spending extra money. So the budget's operating spending challenges and an elevated deficit could mean that margins for error is pretty small. One analysis put it is high stakes, narrow margins. The goal is to spend into growth. And if it works, great. But if all those headwinds, those macro headwinds from global trade, get in the way, then we've spent a lot and we're not seeing the growth that we need. So what does it mean for investors? As I mentioned, infrastructure, clean energy, domestic industrial, manufacturing firms, they could all see tailwinds from this budget initiative. On the flip side, given those headwinds that Canada's faced in trade, investment weakness, weak sentiment, companies are heavily dependent on exports, and that global trade may be facing a lot of headwinds. For fixed income investors, so the bonds in your portfolio, you should take note that the budget comes at a time when Canada's long-term bond yields remain pretty competitive versus its peers. Lower fiscal credibility, though, higher deficit could weaken that growth and could put some pressures on yields, which would put pressure on Canadian debt and duration exposure. So be careful of long duration fixed income there. For equity investors, this budget as a backdrop, as I mentioned, Canadian stocks with domestic growth while maintaining some global diversifications for that export sensitive names, right? So let's highlight a few things that we can carry from October into the end of the year. Diversification matters. Your asset allocation matters. Where are your risk exposures? Global markets continue to exhibit pockets of strength, but a lot of macro risk remains elevated, especially from trade, geopolitics, and monetary policies. Canada's domestic story is gaining importance. All of a sudden, I actually commented to a few people before the Canadian budget came out that the Canadian budget doesn't usually move the needle very much, but with this budget shifting towards investment, domestic growth is going to rely partially, if not heavily, on Canadian spending, on government spending, to see the Canadian equities take advantage of those growth opportunities. And that's where that balanced portfolio, more exposure to value in there is going to be important. Interest rate and those yield pressures are really going to play into the fixed income portfolios. While inflation's easing in some regions, central banks are still very cautious. The timing of those rate cuts remain really uncertain. So fixed income and duration positions remain super important. Trade and export risk is at the forefront of what's going to help Canada succeed. So we've got to be really, really cautious of external shocks because the budget can support that growth, but it won't eliminate those risks. So what are we doing in the portfolios? So using the Canadians budget as a positive signal for domestic-oriented sectors is a must. But don't let that overshadow the importance of global diversifications. Yes, we're running light on our US and international exposures, heavier Canada, but we're still trimming our profitable names to raise a bit more cash, always maintaining that risk first exposure. We do have higher cash positions in the portfolios right now to take advantage of pullbacks, to look for real value in sectors and geographies. We continue to monitor that macro development very closely, especially that trade, monetary policies out there that may impact both Canadian and the global side of the portfolios. Overall, we do like the infrastructure. We've all year liked the utility or industrial side of things, and we continue to overweight those. So with that, that wraps up our market update for October 2025. If you'd like a deeper dive into a specific Canadian sector or just want to discuss budget, how the budget might impact you or your portfolio strategies, we're always here for you. Reach out to us, email, phone, go to mikeonmoney.com or llcprivatewealth.ca. With that, thanks for watching. Don't forget to subscribe or reach out to subscribe to our monthly email, and look for the next Mike on Money video. We're talking about thematic stock bubbles and what to look for. And obviously with AI in the news, you want to see for yourself, are we in a AI stock bubble or not, and what to be careful for. So with that, thank you. Until next time, we'll talk again.